In 1973, in response to the Yom Kippur War, OPEC introduced an oil embargo which caused prices to rise 300%. It ushered in an era of petrol shortages, high inflation and political volatility. 6 years later, in 1979, the Iranian Revolution caused another 300% rise in oil prices. This caused a second bout of inflation and the deep recession of 1980 to 81, with both very high inflation, high interest rates and a deep recession. After falling in the early part of 2025, oil prices have recently started to increase on the back of growing conflict in the Middle East. If Iran were to close the Straits of Hormuz, Citigroup suggests oil prices will rise to $90. JP Morgan say, in a worst case scenario, 120 to 130. And even if the straits aren't fully closed, the cost of insurance, the cost of transporting oil from the Gulf to China has already more than doubled since last week. Currently, 20% of the world's oil passes through the straits, and any disruption would cause oil prices to rise even further. Higher oil prices would inevitably lead to more inflation. You can see here there's a pretty strong relationship between movements in oil prices and US inflation. The global inflation of 2022 was in large part caused by rising oil and gas prices. This not only increases the price of petrol and gasoline, but the cost of transporting just about every good. In particular, the new conflict has caused a big rise in the price of refined petroleum products like jet fuel and diesel. The UK imports a third of its diesel and 2/3 of its jet fuel. Expect air tickets to go up pretty quick soon. It is true that the world is less dependent on oil than in the 1970s. These days we have more fuel-efficient engines, more electric vehicles. Not everybody will face higher petrol prices. But from food prices to transport, oil is still deeply embedded in the global economy. Furthermore, rising oil prices create the wrong kind of inflation. That's inflation due to rising costs and not due to strong demand and rising wages. When the cost of living jumps because of higher oil prices, it can easily cause a fall in real wages, exactly what we saw in 2022. And we end up with the worst of both worlds, stagflation, higher prices but lower real wages and lower economic output. Also, oil-induced inflation creates a headache for central banks. Do they A, increase interest rates to reduce inflation, or do they B, reduce interest rates to help with falling economic growth? Well, if 2022 is anything to go by, high inflation will lead to higher interest rates, even though these higher interest rates do little to address the root cause of this kind of cost-push inflation. Higher interest rates or no further cuts will certainly have a big impact for heavily indebted households. It will also be bad news for the government, who's seen a big rise in deficits in recent years. And of course, the jump in bond yields and interest rates starting around 2022 has caused debt interest payments to become a major part of government spending in pretty much every advanced country from the US to the UK. Now, a reduced supply of oil through the Straits of Hormuz would particularly affect the Chinese economy. China imports nearly 1.8 million barrels a day from Iran. Now, given that the Chinese economy has already been struggling this year with the ongoing tariff war, it would be another unwelcome shock to the Chinese economy. Now, you could say it's pretty unlikely that the Straits of Hormuz would be completely closed, because economically, Iran would be the biggest loser. It can ill afford to lose oil exports, which are the main source of its revenue, propping up a pretty depleted economy. And certainly China will be keen to avoid closing this source of oil imports. Also, it is worth bearing in mind, Iran is not the only country with territorial waters in the Straits of Hormuz. Oman and the United Arab Emirates will definitely want to keep the straits operating normally. But whether oil prices go up or down, the potential for widening conflict is yet another factor contributing to global instability. Even before the crisis, the world was seeing unprecedented levels of economic and trade uncertainty. Now, although the trade war has somewhat faded from headlines, it is still very much a reality that is yet to be fully felt by the global economy. Despite some moderation of tariffs in recent weeks, the budget lab at Yale argue that as of June the 17th, the average US tariff rate for consumers is 15.8%. That's the highest level since 1936. Now, this is lower than the temporary tariff rate we saw of 22% in mid-April, but it is still high enough to cause significant disruption to the household cost of living and also the cost of production for many firms. One of the big effects of higher tariffs in 2025 has been the impact on reducing investment. With tariffs changing pretty much every week and business uncertain what will actually happen to their costs, many around the world are delaying their decisions about when and where to invest in building new factories. And the threat of more disruption from the Middle East, whether it be higher oil prices or just global instability, will only add to that uncertainty and delay in investment. And unfortunately, the global economy is pretty weak. After a strong growth in 2024, the US saw a contraction in the first quarter of 2025, with GDP falling 0.2%. Now, to some extent, this reflects some of the statistical noise of firms importing large inventories to avoid tariffs. But I think with consumers increasingly stretched, there is a risk that this decline in growth will become more permanent. The Federal Reserve recently downgraded their forecast for US growth to just 1.4%. And this is before the effects of the new disruptions we're seeing in recent days. And a further fall in consumer sentiment would be damaging for not just the US economy, but any economy around the world. And yet, despite this fall in economic growth, the Fed chose not to cut interest rates because they see an unwelcome combination of persistently high inflation and also rising inflation expectations. Consumers are certainly pessimistic about inflation prospects, with one-year inflation expectations running at 6%. Now, it is possible that consumers are overly pessimistic about the impact of tariffs on inflation. Yet, ironically, high inflation expectations can themselves become self-fulfilling as firms raise prices in anticipation and workers demand higher wages in anticipation of prices going up. Yet probably it would be the rise in oil prices which would do the most to actually cause high levels of inflation to return. Now, the other underlying trend of 2025 is the growth in government debt, or more accurately, a market reluctance to keep buying government debt at low interest rates. We've seen a surge in bond yields in the United States, Japan, the UK, many advanced countries. The United States in particular is forecast record levels of government borrowing for peacetime. Any kind of conflict or economic shock, of course, usually cause even higher levels of government borrowing, and they're already high to start with. And of course, not only will borrowing possibly go up, but also higher interest rates would again increase the cost of servicing the debt, creating a very unwelcome dynamic. Now, it is worth bearing in mind that higher oil prices are not guaranteed. Oil prices were falling in 2025 for two main reasons. Firstly, global oversupply, and secondly, weak economic growth, partly caused by the trade war. And these two long-term factors won't go away. OPEC could probably quite easily increase supply. And in fact, the fall in the oil price was so extreme it was causing some high-cost producers, including US producers, to actually shut down production because it was no longer profitable. Higher oil prices could ironically lead to increased US production. Now, the US is certainly in a very different situation from the 1970s, when it imported up to 40% of its oil. Today, it only imports around 9% of its oil consumption, so it is less affected by the global price. Nevertheless, financial markets already have many warning signs and frailties, and could they really absorb another big shock like a rise in oil prices? Because certainly just a few years ago, it really devastated both the cost of living, the economy, and people's dissatisfaction with their government. This video goes into more details looking at the potential for a financial crisis in 2025. It seems to be a year of big shocks. Anyway, thanks for watching. Subscribe if you think it's worthwhile, and I'm sure there'll be lots more global economic events happening pretty soon.